Welcome back to the Wall Street Podcast. Today we're doing a deep dive into a recent report from Morgan Stanley Asia Limited. It's titled Investor FAQs on Anti-Involution Growth and Reflation Glide Path, and it just came out on August 8th, 2025.
That's right. It's authored by Robin Jing and Jenny Zhang, and it offers some pretty critical insights into China's current economic dynamics. It looks at the anti-involution campaign, growth and reflation prospects, economic rebalancing, and also the impact of, well, recent U.S. tariffs. Our goal here is really to pull out the most important takeaways for you.
Okay, let's start with that anti-involution campaign. For anyone maybe less familiar, it's essentially China tackling internal overcompetition, overcapacity in key sectors. What's Morgan Stanley's base case here for reflation and growth?
Well, their base case actually projects deflation persisting into 2026. They see a gradual but what they call a durable exit, which suggests, a real recalibration happening. They're even using something called a social dynamics indicator to sort of gauge the public response to these efforts.
Interesting. And how is this push playing out on the ground?
It seems quite measured at the sector level. You see specific actions in steel, coal, cement, solar, mostly production and price controls. To give you an idea of the detail, they even mention a mandate to cut 1 million breeding sows in pig farming, so very granular supply-side stuff. But overall, they think the near-term growth impact will be milder than, say, the 2015-18 reforms.
Right, a more targeted approach this time, perhaps. So beyond anti-involution, what other economic rebalancing efforts are highlighted?
Near term, the focus is still very much on cyclical consumption boosters, things like expanded subsidies for newborns, RMB 3,600 a year for under threes and free preschool, plus those trade-in programs for cars, appliances, electronics,
Standard stimulus measures.
Exactly. But the report really stresses that structural reforms are the key medium term. We're talking social welfare reform, debt restructuring, and, crucially, rekindling private sector confidence. China seems to be aiming for this new growth algorithm, reforming the fiscal system, maybe realigning macro targets, changing how officials are evaluated, all to prioritize household consumption.
That shift towards consumption as a core metric is definitely something to watch. Now, these big picture shifts often bring specific rule changes. One mentioned is a new compulsory Social Security contribution rule. What's that about?
Okay, so starting September 1st, apparently all employers, and that includes about 125 million individual businesses, have to contribute. It's around 25–30% of the minimum social contribution base for their employees.
That sounds significant.
It is. The report estimates an annual burden of RMB 1.3 to 1.6 trillion just for those individual business entities. So while the long-term goal is better labor protection, you can see how it might disrupt smaller businesses, maybe even jobs in the short term, a big adjustment cost.
Definitely a transition challenge. Now, shifting gears to external factors, U.S. tariffs. How does Morgan Stanley see the recent re-escalation impacting China's exports?
They do forecast a slowdown in export growth for the second half of 2025, partly due to higher U.S. tariffs hitting the rest of the world and also some payback from earlier, front-loaded shipments. However, and this is key, they see the risk of U.S. tariffs on China going back to truly prohibitive levels as pretty low.
And why is that?
Primarily because of U.S. reliance on Chinese goods. The report states that nearly half, 48% of China's exports to the U.S. are in categories where the U.S. is considered highly reliant. Makes it harder to just cut off.
Okay, that makes sense. Let's circle back to deflation. Morgan Stanley sees it persisting through 2026. That's a long time. What's driving that outlook?
The main factor seems to be weak final demand. They expect only limited pass-through of any upstream price hikes down to consumers because demand just isn't strong enough to absorb it. The report projects, get this, 15 consecutive quarters of GDP deflation, starting back in Q2 2023 all the way through Q4 2026.
15 quarters. Wow. That signals a real focus on structural stability over just chasing inflation targets. So bringing this all together, let's think about the impact on daily life. How might, say, those consumption subsidies actually change how households spend? Or how does that Social Security rule feel to a small shop owner?
Well, you clearly see the tension, right? There are these short-term boosts, like the subsidies trying to get people spending now, but then there's the simultaneous push for deeper structural changes, like reorienting the whole economy towards consumption long-term via that new growth algorithm. It suggests the path to durable reflation isn't straightforward. It's complex, needing both immediate action and those much bigger systemic shifts.
So the big question for you, our listener, to consider is this. What are the broader implications if China actually succeeds in this pivot? Shifting its growth model towards consumption, making that the core metric, all while managing this predicted period of persistent deflation. The ripple effects for global markets and perhaps your own strategies could be quite profound.